high. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring you the story behind the latest developments in the banking space. Today is 4th of January and I am Ruchika Chitravanshi. In today's episode, our cover story will talk about why RBI is worried about Bank-NBFC linkages. In Banker's View this week, we have with us Joint Group CEO of Policy Bazaar, Sadhbir Singh. For Banking for You, we will tell you all about the sovereign gold bonds. Our consulting editor, Tamal Bandhopadhyay, joins us to discuss the key themes for the banking sector in 2024. At the end of the show, we will tell you the results of the last week's poll and the question for this week. As the new year approached, the Reserve Bank of India had, in December, asked non-bank finance companies to broad-base their fundraising. In effect, the regulator wants NBFCs to limit their reliance on banks. So why is the RBI worried about Bank-NBFC linkages? Manojit Saha and Bhaswar Kumar analyze the data and expert opinion to bring you the answer.
Non-banking financial companies or NBFCs are an integral part of the Indian financial system. They have consolidated their position in recent years, as reflected in a gradual rise in their credit intensity, or the credit to gross domestic product ratio, as well as the relative importance in credit provision vis-a-vis scheduled commercial banks. There are 9,480 NBFCs in the country, including 97 housing finance companies and 507 systemically important non-deposit taking NBFCs. The NBFC sector is dominated by systemically important non-deposit taking NBFCs with a share of 85.4% in the total assets of the sector at end March 2023. A key regulatory concern due to increase in linkages between banks and NBFCs is that NBFCs maintain borrowing relationships with multiple banks simultaneously. Banks are also key subscribers to their debentures and commercial papers. The Reserve Bank of India has said that such concentrated linkages may create contagion risk. The RBI's recent Trend and Progress report, which is published annually, referred to the interconnectedness between banks and non-banks and warned about contagion risk. Although banks are well capitalized, the report said they needed to constantly evaluate their exposure to NBFCs as well as the exposure of individual NBFCs to multiple banks. The other concern of the regulator is increasing dependence of NBFCs on bank borrowing. The interconnectedness of NBFCs with banks has increased in recent years in view of their growing reliance on banks for funding needs, indicates the Trend and Progress report.
There are 3 or 4 sort of areas which would certainly draw the regulator's attention. One, of course, is that NBFCs depend a lot on public funds, including the bank funds, basically. So, and there, of course, there could be a systemic risk because, banks carry those as exposure. The second area is if you look at the NIMs of NBFCs, the net interest margin, and the banks end up earning about 3.5% at the most. An efficient bank. The average would be about 2.5, 2.7. Now, in that situation, then the NBFCs normally, some of them, the ones that we are referring to, the B2C type of fintechs, they earn something like 8%, 9% NIM basically. So, what you're really doing is using the bank's funds and then deploying them and then charging much more to the borrowers. So there is an unfairness in that element, second. And the third is we realize that when the economy does not perform well or it starts taking a downturn, the first thing that gets hit is small loans and unsecured loans.
RBI said NBFCs should focus on broad-basing their funding sources and reduce over-dependence on bank funding.
One thing is given, that the RBI is not going to issue deposit-taking license to NBFCs. It has almost stopped doing that for the last several years. So, therefore, there is a pressure that will be there on the NBFCs, and particularly with the last few regulations that the regulators come out with, plus the signals in the monetary policy also, it will certainly make it difficult for the NBFCs really to get funds from public funds, particularly either by way of, let's say, issuance of paper or from the banks. In which case, NBFCs genuinely, should start finding alternate methods of liability management. The question is not the assets any longer. The question is, where do the funds really come from?
At the end of March 2023, bank borrowing replaced debentures as the largest source of funds for NBFCs. It continued to exhibit high growth till the end of September 2023. Around 2/3 of NBFCs' borrowing is payable in more than 12 months. Borrowing from banks was 37.8% of the total borrowing as on September 2023, moving up from 37.7% in March 2023 and 35.6% in March 2022. While the regulator has been asking NBFCs to diversify their borrowing sources, non-banks are making a case for allowing more NBFCs to accept public deposits. RBI has not allowed any new NBFC to accept public deposits in almost 2 decades, and the number of NBFCs accepting public deposits has been reduced to just 26 as of March 2023 from 220 at the end of March 2015.
In an exclusive interview with Business Standard's Manojit Saha, Joint Group CEO of Policy Bazaar Fintech, Sarbvir Singh, narrates the impact of the taxation changes in the last budget and offers a sneak peek of the company's performance in FY24 so far. Here's the chat.
Hello and welcome to the Business Standard Banking Show. 2023 was a roller coaster for the insurance sectors. A host of regulations was introduced with an aim to increase penetration. New regulations were introduced for providing flexibility to the insurance companies. How will 2024 be for the insurance companies? As we enter the last quarter of the financial year, will the sales improve? To discuss some of these issues, we have today with us Sarbvir Singh, Group CEO of PB Fintech. Mr. Singh, welcome to the show.
Yeah, thanks, Manojit. Happy to be on your show.
Thank you, sir. Let me start with the growth numbers that we have seen in the financial year so far. With new business premium for many insurance companies, including the LIC, was muted, mainly because of the taxation changes that we have seen in budget of this year. Do you think the trend will change in the 2024?
So I think, there were a couple of factors I would say towards that. One was the factor that you referenced, which was the change, in the budget, which actually impacted more policies which are larger than 5 lakhs. So if the premium for the year is greater than 5 lakhs. So I think, but that at some level, I think created a bit of a, I would say, a lot of business got pulled into March. So it was a bit slower after that. I think the second thing was also that, guaranteed products, the non-par products, they were very popular till last year. And now this year, what has happened is with rates going up, I think the, deposit rates have gone up. And so they, especially depending on your tax bracket, they don't look as attractive as they were looking last year, because last year the guarantees were higher than the deposit rates. And this year, the guarantees tend to be less than equal to. And I think that, again, like I said, it depends on your tax situation, but they're less attractive. So I think those were two factors, which is why you've seen that ULIPs have actually done better this year. So if you see the composition of the industry also in the first sort of 8 months, that the data that we have, the composition of the industry has also somewhat changed, where ULIPs have done better. Some of these guaranteed products and other products have not done as well. Now, I think if you look at the next quarter, which is the last quarter of this financial year, I think that quarter will be similar to what we've seen in the first 8-9 months, because the same factors will play out. Now, going
also the base is very high for the last quarter.
Exactly, and March will definitely be a difficult month because last year the base was very, very high. So I think that factor will play out. But as you look beyond March, I think then things will normalize again. And I think we will, see probably a return to a more normal growth level. And that's why I also feel that we should look at 2 years in a row. I mean, you should look at 2 years together, and then you'll find that it gives you a much more normalized growth rate. which is probably, which is probably a more fairer way of looking at the industries.
Now, coming to term policies, what has been your experience in the term policies in this financial year? I'm asking this because term rates have declined. So, has that boosted sales?
So I think in term, two things have happened. Term, we had a difficult period, especially after COVID, because I think reinsurers had become very strict and things like that. So, that market actually struggled for a couple of years. And I would say this year, for the first time after 2 years at least, the term market is growing quite strongly. And I think that is because of the fact that one is that the rules have become much more clearer, I would say. So I think things have become much more logical. The prices are at a point where people can, term has always been an affordable product. Even 2 years ago, it was affordable. Even today, despite the price increases, it has been affordable. I actually don't think, Manojit, that prices have really come down or anything like that. I think prices are more or less, I would say, stable. In fact, some people have raised prices, some prices have been corrected. So I would say the prices are stable, but I think demand has come back because issuance is better. See, in term insurance, the problem is that if 100 people buy the policy, probably only 67, 68 people or 70 people will get the policy, right? So that number actually had gone down. It had, gone down to even sub 60 levels. So now the fact that issuance is happening, I think people are more comfortable in buying term. Term continues to be a fantastic value proposition, and I think today term rates in India are still lower than term rates in developed economies, where clearly the life expectancy and quality of life cannot be compared, right, between the two situations.
And finally, on the financials, PP Fintech's Q2 losses narrowed significantly. So when do you see that profitability on a sustainable basis?
Yeah, I think again, I would not want to speculate on anything. I think it has been our stated. I think Yashish has said that on the last call also, that we expect to be profitable soon, and I think more importantly, I would again urge you to see the direction of the results, right? That's a number, right? It's a number which will hopefully be reached, but more than that, I think if you see the direction, our core business has continued to be significantly profitable quarter after quarter now for the last, I think, 5-6 quarters. Our new initiatives have scaled up, and the investment in those initiatives has also kind of is sort of going down or is flattish. So I think the shape of the business is in the right direction. I think our contribution margin, if you see, is very significant. So every rupee of revenue that we get brings in certain profitability, and then that starts to cover the fixed cost. So I think that is kind of one of the factors. And every quarter, I think we've been making sort of progress. If you see, we've kind of just kept doing whatever we said we would do. We haven't changed our strategy in any way, in the last 2 years since we became public. And I think the good news is that has worked, right? And that the model seems to be working. So if that model continues to work, you will find that, as the more revenue comes in and it creates, we have contribution, that will slowly but surely keep covering the fixed costs in a bigger and bigger way. There was one technical thing which I think your viewers and you should always keep in mind, that we had this whole charge for ESOPs, right? And that charge, obviously works it's an accounting charge, that the dilution of the shares, etc., has already been done, right? That was done at the time of the IPO itself. Right. So I think it's a charge that was being taken, and that charge, works in a mechanical way, and it keeps going down every 4 quarters. So that's the other reason why, while sometimes the optical results have looked like as if they are very red, but we have never felt that, because we could see that, it was related to some of these charges and things like that. And that is coming down. So yeah, I think it's a long answer to your question, but
no, but the point you have made is that the model is working, and the path is very clear going ahead. That is the crux of the matter, if I can understand you correctly.
True, absolutely.
Right. On that note, Mr. Singh, it was a pleasure talking to you. Thank you for speaking to Business Standard.
Thank you, Manojit. Happy New Year to you and to all your viewers.
Sovereign gold bonds, or SGBs, have become a go-to investment for investors looking for safer bets and higher returns. The first tranche of sovereign gold bonds was issued in November 2015 and matured in 2023. Reportedly, investors were able to reap a healthy return of over 12% by investing in the SGBs issued by RBI. But what are sovereign gold bonds, and should you invest in the next tranche? Shivam Tyagi looks for answers.
Sovereign gold bonds are government securities denominated in grams of gold with a basic unit of 1 gram. Each bond represents a certain amount of gold, providing investors with a convenient and a secure way to own gold without the need for physical possession. The issuance of SGBs is undertaken by the Reserve Bank of India on behalf of the Government of India. This makes them sovereign-backed instruments, making them a secure investment for investors. That's why finance pros treat them as a more dependable alternative to the possession of physical gold. The bonds mirror the value of 1 gram of gold and are released in batches known as tranches on specific dates during the year. For the financial year 2023-24, the Reserve Bank of India planned 4 batches called tranches of sovereign gold bonds, out of which the window to apply for 3 has already passed. The Series 4, however, is scheduled to open from 12th to 16th February in 2024. The pricing of sovereign gold bonds is determined by the average closing price of gold with 999 purity over the previous 3 business days from the day of repayment. Sovereign gold bonds or SGBs are open for purchase to any residents of India, extending eligibility to Hindu undivided families, trusts, universities, charitable institutes, and joint holdings. Additionally, guardians have the privilege to apply for SGBs in the name of a minor. Investors can purchase SGBs from participating banks, Stock Holding Corporation of India, Clearing Corporation of India, designated post offices, the National Stock Exchange, and the Bombay Stock Exchange. The maximum subscription limit for individuals and Hindu undivided families is 4 kilograms, while trusts have a limit of 20 kilograms. SGBs not only provide potential gains from prevailing gold prices, but also ensure a fixed 1.25% return paid twice a year based on the initial investment. The maturity period for the gold bonds is 8 years. It also has the option for premature redemption after the 5th year. Investors can exercise this option on the date of interest payment according to the Ministry of Finance. While the interest earned on SGBs is taxable, individual capital gains tax upon redemption is exempted, offering a tax advantage over physical gold. SGBs are also tradable on stock exchanges, providing liquidity to investors who may choose to exit before maturity. Additionally, investors can convert their physical SGB certificates into a demat form for ease of handling. According to a report by Value Research, till November 2023, RBI has issued 65 tranches of SGBs, collecting a staggering 56,762 crore rupees worth of investments. Sovereign gold bonds contribute to the government's efforts to mobilize household savings, reduce the demand for physical gold, and promote financial inclusion. Investors benefit from the dual advantage of potential capital appreciation linked to gold prices and fixed interest income, making SGBs an attractive investment option for those seeking exposure to gold in a convenient form.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
So, sovereign gold bonds not only provide potential gains from prevailing gold prices, but also ensure a fixed 2.5% return. Let us put a pin on that as we will talk about this later in the show. For now, it is time for our Expert Take segment with Tamal Bandhopadhyay, where he talks about the macro and the micro themes of 2024 for the banking sector. Hi Tamal, welcome to the Banking Show. This week, in your column, you have said that the central theme of this year would be to fight inflation for growth. Can you elaborate a little what this means in terms of RBI's policies and overall for the banking sector?
Yeah, thanks, Ruchika. I think it's a classic situation where we miss the woods for the trees. So not everybody, I am correcting myself. There are certain quarters feel that, well, we have been able to contain inflation. Now it's the time for a rate cut. That's not the case. If you look at the numbers, it's 4 years now. We are away from the central target for inflation, which is 4%. So 4% plus minus 2 percentage point on either side. That's the overall target. But 4% is the central target. Where are we? So this more than 4% inflation for the past 4 years, you look at how it has been eroding the power of consumers, the purchasing power. And of course, if we allow to continue, there is some point it will affect growth. So I think in the entire growth inflation dynamics, inflation is a bigger evil, and fortunately, Reserve Bank of India is fully aware of this, which is why Governor Das has kept on saying from different platforms in the past few months, the fight against inflation is not over. So my column this week is, of course, it is the 1st January column, so it's on the central theme of the new year, that's calendar year 2024. And I firmly believe that the central theme will be fight against inflation. It will continue till the inflation genie is bottled within 4%.
So what does it mean for a rate cut? How long do we have to wait?
Well, rate cuts, actually, there are a few movable things we need to take into account. Now, let's presume that geopolitical situations remain as it is now. Commodity prices, etc. That's a separate issue. I'm not getting into that. But the two key elements which will actually create the situation for a rate cut is, of course, the inflation, which is as I said, 4 years above the target. It needs to come down to 4% and quote unquote on a durable basis. So just 1 month it comes down to 4% or close to 4%, and that will prompt Reserve Bank of India for a rate cut. I would not think so. So you need inflation at or around 4% on a sustainable basis for a few months. And second part is this: what's U.S. Federal Reserve is going to do. Now the belief is it would happen during springtime, and Fed can go as many as 3 rate cuts, 25 bips each, 70 basis point. So I would like to believe as and when the first rate cut happens by US Federal Reserve, Reserve Bank of India will probably first change the stance from accommodative to neutral, and we'll keep an eye and fighting against inflation. The fight will continue, and then the rate cut will happen at the next stage. So I would rule it out in the first half. Elections also, general elections around, I think it would happen in the first half. Again, some analysts believe that this is going to happen for elections. I don't think so, because election, in every election, central election, inflation is a big issue. So Reserve Bank of India would not allow people talk about it, that it's for the political masters. The central bank is cutting rate to keep people happy ahead of election. It is not going to happen. It will continue to fight inflation. And as I said, if everything go the way we are thinking they should, in the second half of the calendar year, we may see the first rate cut.
Eyes will be on RBI and US Fed's rate policies as well. Tamal, inflation and interest rates aside, what are some of the micro issues that will play out for the banking sector this year?
Well, I will pick up only two. One is the banks' fight for deposits. Okay, you have seen that it's about 2 years now, the kind of deposit rates the banks are offering. Senior citizens are getting, in some cases, 9% or even more. Certainly 8 and 8.5% for most of the banks. So this fight is continuing. And if you see in calendar year, again, credit growth is much higher than the deposit growth, even though the base is different, but credit base is much smaller than the deposit base. But still, the kind of credit growth is happening. It's not sustainable unless the banks gather deposits, because some of the banks have been supporting this from their capital. It will not continue for long. So the fight for inflation, fight for deposits will continue. Banks will continue to offer higher rates, and if those banks which will not be able to garner enough deposits, their credit growth will slow down, which means at the macro level for the industry also, I don't think the current credit growth is sustainable. That's the same side, the two sides of the same coin. And the second part of this is this: I think the bad loans or the NPAs, which is now, I think the net NPA is not decadal, it's all-time low historically. From the 90s, if I'm not mistaken. So it would be difficult to continue with this kind of trend, because the Bank of India is fully aware of that. In certain quarters, particularly retail segment and personal loan, etc., there is some kind of cracks are happening. We will see that banks are recognizing them and banks are making provision appropriately. So the two key themes, I would say, fight for deposit will continue, and as a part of that, credit growth will slow down or may slow down. And second part of this, the banking sector health will continue to be robust and resilient, but for certain banks, we will see a bad loan as a percentage of credit growth.
Yes, Tamal, indeed, Finance Minister Nirmala Sitharaman, in a review meeting that she took on 30th of December with the PSB banks, had raised some of these issues as well, and also issues of cyber security and onboarding of stressed accounts as well. Very important points there, Tamal, about inflation targets, how we're far from it, and the interest rate cut, and that it is only going to happen in the second half of this year and not likely in the first half. Well, we'll be obviously talking to you all through that time. Thank you so much, Tamal, for joining us today and sharing your insights. It is time now for our poll results. Here's what we asked you last week. Do you expect loans to get cheaper in 2024? Well, 58.7% of our respondents said yes, they do, while 41.3% said they were not so optimistic and said no, they don't expect loans to get cheaper this year. Earlier in the show, we told you all about sovereign gold bonds, the risks, the benefits, and how you can purchase them. The SGBs do present an attractive investment option for those seeking exposure to gold in a convenient form. But we want to hear what you think. So here's what we are asking you today. Would you prefer the sovereign gold bonds to FDs? Our poll is open today, that is Thursday, and you can respond on Instagram, Twitter, LinkedIn, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.